Good morning, good afternoon, hello everyone. I'm just gonna kill some time here until we get started. Usually takes a little bit of time for people to join. Okay, yeah, my first like. Thank you, good morning. Okay, I think we are warming up. We'll wait. All right, we are getting warmed up. Let's get, hopefully we'll get a few more people. And we see another person. Hi, Sar. Good to see you. How are you? Hopefully everything is okay. Okay, hey, Nir. Good morning. Gabriela, we don't have events coming up in LA and Irvine. We had them last month, 2-3 weeks ago. So I don't want to create confusion. Thank you for asking or mentioning. All right, we are 2 minutes in. That's usually how how long it takes to people to start joining up. So good morning, good evening, good afternoon, depending on where you are. It seems like usually how I start the session. My name is Danny, obviously you know that. I am based in Southern California, and this session is, there's a lot of Hebrew speakers here, but this session is open to the public. So we have people from different parts of the country and actually in other parts of the world as well joining us. So that's why we're doing this in English. And obviously we're going to talk about real estate investing, no doubt. This session is primarily for you guys, so you are most welcome to contribute, to add, to ask questions. Oh, right, absolutely. We do have 2 events coming up. I'll talk about that in a second. Thank you. I guess confusion is all mine. So this session is for you to ask questions. Direct me if you want. I have my own topic for today. I'm going to be attempting to be as briefly as possible or short as possible today because we have a closing on a flip property in Chicago that's not going so smoothly throughout the day. So there's a lot of moving parts that are time sensitive. So I'll try to, I'll have to wrap up this session quickly or quicker than usual. I want to say one thing. We have 2 events coming up. We have an expert on the topic of land trusts who's coming down to Southern California. He's based in Chicago as well. And he's coming down to Southern California to talk to us, to teach about the whole concept of land trust. We have one event in LA and the other one in Irvine. I don't have the dates in front of me. I am using land trust to buy and own real estate for probably 3-4 years now. I follow this guy's teaching and education and structure, how to go about it. So he's a teacher. He's the one who shares the information. So I recommend you take the time to participate. It's very practical and very a good thing to know about land trust and how you can incorporate them into your real estate investing. Today I want to talk about ROI, return on investment. So if you have any questions, by all means, let me know. But the topic for today is ROI, return on investment. And I'm going to say this. I think there's maybe, ROI, everybody knows what ROI at large is, but I think there's a lot of missed calculations when we're talking about ROI, okay? So I want to share with you how I calculate ROI because I want to make it, as realistic as possible. And I want to share that with you. So the first thing I want to say is actually what I'm seeing out there that usually is not being done properly. So when we analyze rental properties, we have an Excel that we've created and improved and fine-tuned over the years that we use, that it's probably the best tool that I have found for me to make decisions. I've been using it for quite a few years and many times. Probably used my own Excel for well over 10,000 times. So for me, making a decision about a property without running the number through the Excel is not even something I feel comfortable doing anymore. I'm so dependent on that tool. The way I'm looking at this Excel, or the whole concept behind the Excel, is this. When we analyze rental properties, we want to probably not use the worst case scenario, which I've used for many years. Definitely don't want to use the best case scenario. So what we need is probably somewhere in the middle, what I call the realistic case scenario. Very trivial, but I can tell you that for years I haven't done that myself. I use somewhere closer to the worst case scenario. And when you use the worst case scenario, you always have the worst case, and then you end up not investing. So I decided I need to change my approach. So one thing, I wanted to be realistic, or realistic case scenario. So try to be as realistic as possible, maybe with a little bit touch of conservatism. So not to be overly optimistic, but not to be overly conservative. The second thing, that I knew that I have to do in order to accomplish that, using the realistic, is I want to make sure I can really account for all the figures as much as I can, and not just going to be ballpark figures, right? I sometimes see properties or people or marketing information, sending information out there with a very, let's just say, not complete details of the investment aspect. For example, things that I many times don't see people analyze or account for, typically HOA, vacancy, and leasing fee. So those are three factors that sometimes are included, sometimes are not. Those are real costs that we would have when owning real estate, primarily, if we're using property management. So HOA, of course, other costs as well, but those three usually tend to disappear from the formula, or disappear from the marketing material, or some of them. Now, I have learned over the years that real estate, or this type of real estate, this is not big numbers game. This is actually small numbers game, right? So if I don't account for vacancy, that will affect my bottom line, quite significantly. If I don't account for HOA, or I don't account for leasing fee, that will affect, my bottom line quite dramatically. So I want to make sure I account for property, property taxes and insurance, and estimated repairs and vacancy and management fee, and leasing fee and HOA, and if there's anything else I need to account for, include that, because those are the real numbers, right? Just by ignoring them, obviously they're not going to go away. They're there. So just be sure to begin with, you have all those figures in, and realistically, maybe a little bit conservative. Realistic, of course, we want to know what the rent is, but those are the things you want to account for, just as a starting point. Many of us, just for some reason, don't remember all of those things. Some of them, most of them, but not all of them. It's important. Second thing is, so that's one thing that I'm seeing a lot of people, companies, organizations out there not putting all the numbers in properly. That's important. The second thing I want to talk about is how you really should be calculating the ROI. So I look at an ROI as a compounding of three factors. Okay, one is the cash aspect ROI, or cash on cash, that we know. So that means actual cash flow compared to my actual investment. So when I measure an ROI, my baseline for investment is not the down payment, is actually how much cash I needed to shell out of my pocket in order to buy this property and get it all the way to the point that it's rented, right? So it's so it's down payments, purchase costs, mortgage fees, some other fees to make the house ready for renter. All of those have to be included. So that's my baseline for calculation, how much money I really shelled out of my pocket. So number one, create the baseline. Number two, that's the more important thing. My first factor, ROI, is cash. So how much cash flow I'm accumulating in 1 year, compared to my cash outlay, my actual cost to purchase the property. That's number one. Number two, I do calculate or add appreciation. Now, I don't use it in the sense of appreciation that many people think about when I say appreciation. The way I consider it is more inflation rate, okay? So even if I know in today's market, a lot of the metros in the US are doing 6, 7, 8%, maybe even more annual appreciation, I don't care about that. I'm blocking that away, not because it's not real because it's more speculative, right? But we do have inflation in this country. So for me to factor maybe a 3% inflation rate annually on average, it's something that it's real. It will be, in my property over the years. I am definitely want to, account for that. So I add inflation rate. I know that in historically speaking, over the long term, houses do tend to appreciate actually more than that over the long term. Of course, we have ups and downs, but I want to take something that it's small. I can somewhat rely on, I can rely on it. It's tangible. So not appreciation in the common sense, but more inflation rate, maybe 3%, maybe more, maybe a little bit less, but you get the point. So that's number two. So number one was the cash on cash. Number two, inflation or appreciation in inflation rate. Number three is the fact that when I buy a property with a mortgage, right? Obviously, I'm borrowing, money. I'm borrowing a principal to purchase the house. That's nothing new about that. But when I am calculating my cash flow represents mortgage payments. Mortgage payments represent principal and interest. So that means every year, slowly, right? Not in a straight line, but slowly, my mortgage principal gets lowered year after year. So I may start with a $150,000 mortgage, and maybe 5 years later, I owe $140,000, right? Whatever the number is. So that means those $10,000 are something that I already have. They are now belong to me, although they're sitting in the walls of the house. They're not in my pocket. But when I come to sell it, it is something I need to factor. So I call it return on equity on the fact that we are paying down the mortgage principal, right? Remember, the mortgage principal is not ours when we borrow it. Every time we pay, a rent is paid and we pay, the mortgage payment, that principal goes down. So that means it becomes my money. I borrow it, but it becomes mine. So three factors are return on equity because we're paying down the mortgage principal, return on equity because we have a little bit of inflation rate appreciation, okay? And the cash on cash. Those three things really give me, the full picture of the analysis of the ROI. And when you do that, you'll see that your ROI, obviously gets improved very, greatly. Now, some of you may say, I can't get those mortgages. I'm buying cash, and that's okay. When you do that, obviously your ROI will change, but your cash flow will change as well. You'll have a higher cash flow because we don't have a mortgage payment. So it will affect your ROI. So you can say, listen, I'm gonna measure I will analyze the rental property without the mortgage, and you'll see, you'll have to look into the numbers yourself, but at least you can still count on a minimal appreciation, inflation rate appreciation. Last thing I want to say about is that when I analyze rental properties, I don't care what the performance is on the first year or the first month. That doesn't tell me anything. It doesn't really reflect the life of the investment, because the first year is usually the worst one in terms of performance, because there are costs associated with purchasing, there are costs associated with running, making it ready for rental. Usually it's not the ideal year to check. So I would say what I like to do is I analyze, the property, every single property, over a term of 30 years, right? And I want to run periodic averages for the first 5, first 10, 15, and 20 years, and see what the performance is during that window or period of 5 years. What's my cash flow is going to be over 5 years? What's my or ROI is going to be over the 5 years? And that gives me a much better, much clearer understanding of what the return on investment is. So when you do that, remember, it's sometimes, if you do it in a different way, you may find that you just analyze the first year and you'll see, oh, that's not such a good investment, right? Because usually the first year it isn't. And so you probably want to take a little bit more wider perspective on that reflect your plan, right? Why wouldn't you analyze a property over at least 5 years if you're probably going to hold it for 5 years anyway, right? So that should be a reflection of that. And the second thing is, make sure you're not neglecting the other components, which are the return on equity and appreciation. So those are the things I wanted to mention regarding analyzing rental properties. We have an Excel that we use. We share it with our investors that work with us, so they can actually tap into that and run it by them. That we teach them how to use that, so they can actually have a tool to help them make a decision. For the general public, we offer it for sale. It's not that expensive. It depends on the version. It goes for, I think, like $15 to $50, depending on which version. If you're interested in buying it, just let us know. We'll send you a link, or we'll maybe place it here. But the point is, either way, using our Excel or not, have your own tool, and not forget to use the different ROI types when you're actually calculating an analysis. So with that, with that said, I am done with what I wanted to cover, even faster than I thought I would need. If there are any questions, I'll take them now. And if not, we will just wrap up for today. So are there any questions? Okay, I don't see any questions coming in, so thank you everyone for taking the time, maybe 15 minutes, 20 minutes of your day. Really good to see a lot of the names here. If you want to get in touch with us and find out if we can help you invest in rentals or flips, I'll be happy to. Just send us a message, email, we'll take it from there. And I want to wish all of you a terrific Friday and a great weekend and rest of your week. And I have to wrap it up and continue with my closing that's coming up as we speak in Chicago. So thank you, everyone. Have a terrific weekend. Bye-bye.